The honest truth is that our brains are hardwired for financial failure. We spend too much and save too little. We take on too much debt. We panic when the stock market goes down, and we get too risky when the market goes up. Why do we constantly do this? It's because our brains are hardwired for immediate survival, not for long-term wealth building. Back in the days, we consumed whatever we had because tomorrow there might be no food. We followed the crowd because that gave us the best chance of survival. And we reacted swiftly to any whiff of danger because a single threat not taken seriously could mean our death. So if we want to avoid financial catastrophe and set ourselves up for long-term success, we must learn to rewire our survival-prone brain. Let me share with you 10 in this video. And if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number 1 money mindset. We want to rewire our brain to recognize that in the world of investing, hard work does not equate to investment success. In most things in life, hard work is directly correlated to success. You want to lower your body fat percentage to single digits? You have to eat more protein and lift heavier. You want to get that extra sale? You need to make more phone calls. Thus, it's natural to come to believe that if we want to achieve investment success, we just need to work harder like we do with everything else in life. If we read enough corporate annual reports, watch late night talk shows about money, and constantly monitor the ups and downs of the market, we can become investing savants. However, this is far from the truth. While all this activity might give us the illusion of control over our investment results, the reality is that it's likely to hurt our performance in the long run. The more we read corporate annual reports, the more we will want to trade stocks. And the more we trade stocks, the more trading costs will rack up. And not to mention how we're making large, undiversified investment bets. When it comes to investing, rewire your brain. More work doesn't equate to better returns. Smart investing does. Invest in broad market low-cost index funds and spend the rest of your time on more interesting things in life. Number 2 money mindset. We want to rewire our brain to recognize that the future is not predictable. Most events seem obvious in hindsight. In retrospect, it seems obvious that FTX was fraught with issues that led to its bankruptcy. The lack of oversight, the overhype, and not to mention the reckless behavior of its founder. However, was it that obvious? If it was, why did so many people fall for it? This phenomenon is known as hindsight bias. We forget about all the uncertainty that existed at the time and all the predictions we made that turned out wrong. We look at our now sanitized recollection of the past and we feel future events are more predictable than they actually are. This happens again and again after every event. We look at the housing bubble of the late 2000s and the tech crash of the late 1990s and believe that we could have foreseen both market collapses. However, the truth is that the future is not predictable. No one can ever predict the future with certainty. So when it comes to money investing, we want to be careful about making big bets based on our prediction about the future. Don't put all your money in few tech stocks with the prediction that these tech companies will outperform the market in the next few years. Number 3 mindset. We want to rewire our brain to recognize that when it comes to the stock market, there is no pattern. Or more specifically, no short-term pattern. For many individuals that love monitoring the stock market, it's easy to start seeing patterns where none really exist. When we're faced with a sudden shift in the market or a hot new company, we naturally gravitate towards analogies to help frame our thought. Look at the market swings, it's 2008 all over again. Look at this tech company, it moves like the next Amazon. As the market moves up and down, we extrapolate supposed patterns. We assume a rising market will continue to rise, thus prompting us to invest more. Whereas in a falling market, we assume it will keep plunging, causing us to panic and sell. Or the other way around, we expect a reversal, so we rush into buying during a down market and rush to sell when the prices rise. The bottom line is that when we stare at the market long enough, we will start to see patterns where none exist. Our brains are just wired that way. This is how we make sense of complex things. Simplify by grouping into patterns. The best solution to combat this inclination is to ignore the short-term fluctuations of the market. At most, look at the market maybe once a month just to check out how your portfolio is doing, but don't change your investment strategy based on supposed patterns that aren't there. Number 4 money mindset. We want to rewire our brain to understand that while stories attract, at the end of the day, data rules. What do I mean by this? Humans are moved by stories. What piece is more powerful? A story about a soldier who survived through 400 days of combat during World War II? Or the data about how over 400,000 American soldiers died during the war? While the data is more exhaustive of what happened, at the end of the day, we resonate with stories more. So how does this play into money? Academic studies consistently show that investing in low-cost, broad market index funds is one of the best ways to invest in the market, especially for regular individuals like you and I. However, academic studies are no competition for a good stock market story. People get constantly drawn to hot growth companies with their sexy innovations. Just look at the latest string of supposed amazing companies people are head over heels about. Theranos by Elizabeth Holmes, FTX by Sam Bankman-Fried, Frank, a buzzy fintech startup by Charlie Jarvis. People are attracted to these companies because they offered a chance to dream. But like a lottery ticket, they most often end up just that, a dream. Understand the power of stories. They can be used in powerful ways to move positive agendas forward. However, they also have a power to cloud our judgment. When it comes to investing, data rules. Number 5 mindset. We want to rewire our brain to be wary of price anchoring. Suppose that we hear that our neighbors sold their home for $500,000 a couple years ago. You're looking to sell your home now, and given you and your neighbor's home have similar profiles, you think you should be able to sell your home for the same price. You anchor off the price of your neighbor's home. However, the condition of the housing market might be completely different from what it was when your neighbor sold their home. The interest rates are higher, the job market has changed, and you and your neighbor's home sale timelines are different. If you can't get your mind off the anchored price, you might never sell your home. Or if the market has improved, actually price your home too low for the appreciated market. Be aware of our tendency to price anchor. We tend to price higher emphasis in the first number that we hear, and it's hard to get our mind off of that. A good way to combat this inclination is to get a wider set of data. Don't just talk to your neighbor about how much they sold their home for. Reach out to multiple real estate agents. Talk to others who sold their homes recently. Study the market data online so you have a broader view. Number 6, money mindset. We want to rewire our brain to be wary of rationalization. We all do this. After a bad decision, instead of acknowledging and looking for ways to correct our mistakes in the future, we'll often make up stories to make our bad decisions more rational. Oh, I overpaid for that sweater? Well, that's okay, because I want to support that brand anyways. They do a lot of sustainable work. Wait, I'm investing my money in an expensive actively managed mutual fund when a low-cost, broad market index fund will do a better job? Well, actually it's fine. The fund manager seems so nice, and besides, what are a couple percentage points in expense ratios anyways? We rationalize because we want to escape the discomfort that we're feeling with our bad decision. In the world of psychology, this feeling is called cognitive dissonance, a state where we have two contradictory thoughts. They can't coexist together, so we try to resolve it by rationalizing. The thought that I just made a stupid money decision naturally clashes with our self-image that I'm smart with money. So we'll naturally find a way to make the dumb financial decision seem more palatable. I know, because I do this all the time. Why did I yell at the kids? Well, I tell myself it's okay because they need the discipline. Not able to face the truth that it was due to my lack of patience I yelled, and I couldn't come to terms with that fact because of my insecurities. Let's be aware that this is our natural tendency. The more we're aware of it, the more we'll be able to combat it. The number 7, money mindset. We want to rewire our brain to be wary of confirmation bias. At the same time we dismiss and try to rationalize our dumb decisions, we latch onto information that confirms what we already know or believe. We think crypto is the future of currency, so we look at articles that confirm this outlook. We think crypto is a scam, so we look at articles that also confirm this outlook. Like life, most things aren't that simple or straightforward. The truth lies somewhere in between. We might have a certain worldview based on world experience, but let's be careful of confirmation bias. If we want to have a rational approach to our money and a view of the world in general, we must be wary of our own biases. If you torture data long enough, it'll confess to anything you like. The number 8, money mindset. We want to rewire our brain to be wary of mental accounting. Mental accounting refers to different value a person places on the same amount of money based on some subjective criteria, oftentimes leading to detrimental results. For example, think about how people approach tax refunds. Most people look at getting a check from the IRS in the same way they view lottery or gambling winnings. They see it as found money, something extra that they can spend on new things they like. But the fact is that tax refunds are very different from lottery or gambling winnings. The money rightfully belonged to you in the first place. It's right in the way the IRS actually describes this money, a refund. This is restoration of money, in this case an overpayment of tax that you made to the government. It's not a gift that the government gives you because of the kindness of their heart. So we should view it in the same way that we treat our regular income, not as a gift. Or better yet, get annoyed if we're getting a big refund because we essentially gave the government an interest-free loan for the year. We should actually look for ways to minimize that big refund in the future. If you want to learn more about managing your taxes better, I have several videos on it where I go super deep. I'll have the link in the description below. Nonetheless, the bottom line is that let's be aware of mental accounting. A dollar is a dollar, regardless of where it came from, whether it fell from the sky, earned, or spent. However, not all reframing is bad. At times, it can actually work to our benefit, which leads to the next money mindset. Number 9, money mindset. We want to rewire our brain to recognize that we are heavily influenced by how issues are framed. Thus, if we want to improve our finances, at times, rather than working harder, it may be most beneficial to reframe the situation. For example, this concept of reframing money decisions have had some great positive impact on 401k opt-ins. Traditionally, employees when first hired by a company will be asked by the HR manager if they wanted to contribute to their 401k plan. As you can guess, the opt-in rate was quite low. However, when the companies changed their approach, and instead of asking if they wanted to opt in, enrolled them by default and actually asked them if they wanted to opt out, the enrollment shot up. According to a study conducted by Fidelity, a whopping 91% of employees whose companies auto-enrolled them in their workplace 401k did not end up opting out. Fidelity's results make one thing clear. People tend to stick with the status quo, in this case, retirement savings. And this applies to a large part of our lives as well. So leverage the power of reframing. The glass isn't half empty, the glass is half full. It's not that I don't get to spend money, it's that I'm prioritizing my spending. It's not that I can't afford this right now, but rather I'm choosing not to spend my money on this currently. Number 10, money mindset. We want to rewire our brain to recognize that when it comes to money and investing, we want to play the long game, not the short game that everyone else is playing. Experts bombard us with advice that we should save and invest so we can retire in 20 or 30 years. But we can't help ourselves but focus on the here and now, the latest model car, the recent political news, the current state of the market. However, in the long game, the events of the days, the weeks, and even months don't really matter. With money, real movement happens in years, most often in decades. So ignore the short game. That is what everyone else is obsessed about, but you're looking to build sustainable wealth, and that means you're playing a completely different game, the long game. Thank you guys for watching. In the line of long games, if you'd like to learn more about why you want to get rich slowly, please check out my video here. Until next time, all the best.